All right. You found the perfect home in Maryland. You negotiated a deal. You got it under contract. And then the appraisal comes in low. Now what? Well, appraisal gaps, that's when a home's appraised value comes in below the agreed contract price. It's a common hurdle in real estate deals. In this video, I'll break down why appraisal gaps happen and Maryland-specific trends, how buyers and sellers can negotiate a low appraisal, loan-specific considerations for conventional FHA and VA loans, and we'll do real-world Maryland examples and success strategies. So, a low appraisal doesn't have to kill your deal. Let's go over how to handle it like a pro. What causes it? Why do they happen? Well, a home appraisal is how a lender verifies a property's value before approving your loan. If the appraised value is lower than your contract price, that means there's a gap, and lenders will only finance based on the appraised amount. Here's some common reasons for low appraisals. The market could be moving too fast. So if home prices rise really quickly, appraisals struggle to keep up with that. Sometimes it comes in low because there are fewer comparable sales. That means there's not enough recent similar sales in your area, so the appraiser might undervalue the home. Sometimes it's just a really unique or historic house, and homes with special features and renovations or custom upgrades, they just may not have clear comps. Sometimes you've overbid in a hot market. Buyers offering over the asking price to beat out the competition sometimes don't realize the house might not appraise at that level. So an appraisal relies on recent sales, but in a fast-moving Maryland market, kind of what we're in right now, the data sometimes lags behind reality, and that's where the gap is. So what happens if it comes in low? What do? Here are your options. You can ask the seller to lower the price, and the seller can agree to match the appraised value. Sometimes the buyer can cover the difference. That means the buyer has to bring extra cash to the closing to cover that gap. Sometimes both sides decide to meet in the middle and negotiate some kind of compromise. Sometimes the buyer can request a reconsideration of value, which challenges the appraisal. You're basically telling the appraiser, I don't agree with this. You missed a comp here that I would have used, or the way that you valued this is different than how I value it. And the sad one, walk away. If an appraisal contingency exists, the buyer can exit the contract penalty-free if they can't come to terms on a negotiation. If the seller's not going to come down at all, or they're not able to meet in the middle somewhere, the buyer can walk away and get that deposit back, as long as you are within your timelines. Most of the time, buyers and sellers work together to find a solution that keeps the deal on track. If you're the seller, you don't want your house to go back on the market. Every time you do, people automatically think there's something wrong with the house. Most times there's not. It's just an appraisal gap discussion, but good luck selling that to the general public. For the buyer, you've already got this money invested into it for a deposit. You've got this money invested into it with inspections. You are moved into this house mentally. You don't want to see it fall apart if you can avoid it. So more often than not, there's a negotiation that happens where both sides work together and face that appraisal gap and close it. But it's going to take both sides working together. If it's not going to happen, then you can get out of your contract as long as you're within your timelines. Whether you're a buyer or a seller, negotiation is key when you're dealing with an appraisal gap. Here's what each side can do. We'll start with the buy side. Buyers can cover that gap with extra cash. If you really want that house, bringing more cash to closing keeps that deal moving forward, and it's a non-issue. You can request a price reduction. Ask the seller to lower the price to match the appraisal. You don't get if you don't ask. Now, don't expect the seller to be excited about that because they've got this great deal in place right now, but you got to ask. You could split the difference. It's a fair compromise, both sides meeting halfway. You can ask for seller credits. The seller might not lower the price, but they might be able to help with your closing costs. Remember, if you're closing that gap and you have to bring extra cash to the table in order to do that, you can offset that by negotiating some closing costs on the back end from the seller if they're open to it. Again, if there's errors in the appraisal or you can provide better comps, ask the lender to reconsider and challenge the appraisal. For sellers, all right, what do? You got to review that appraisal carefully. look for mistakes. Look for missing sales that support your price. You can negotiate a compromise. You can offer a small price drop or a closing credit to try and keep the deal alive. It depends on how big that gap is. A small gap is very easy to navigate. Now, let's not get hung up on killing a deal over a couple $1,000. If it's a large gap, $100,000 gap, well, then we have another problem. The only way to get a new appraisal is by getting a new lender. That might not always be possible. So, you have to weigh each option on a case-by-case basis. You can hold firm. If you really believe that your house is worth more, you can refuse to lower the price. And if that buyer walks away, you put it back on the market and relist. It's a gamble, but it's a gamble that could pay off in a short inventory market as long as you have the evidence to support. This is not a problem for me. I have the time and patience to wait for the right buyer to come back and buy this. And maybe these one thing that you have to consider, these appraisals are an independent third-party opinion, meaning one appraiser's opinion of value is going to be different than another's. More often than not, you're at the contract price or a little bit above, but if it comes in below, the only way to get a new one is to hold firm, and you have to be prepared to either relist that house or that buyer is going to have to get a new lender to get a new appraisal order. The best deals happen, though, when both sides stay flexible and focus on the big picture. Like I said, take a step back, make sure that this is the property that you want or the property that you want to sell, and look at all the other terms of the deal. If this is the only thing hanging it up, be flexible and focus on that big picture. Do what it takes to make it happen. If it's just an insurmountable moat, then we try again. So different loans handle low appraisals differently. All right. A low appraisal on a conventional loan is typically a little bit more flexible. Buyers can adjust their down payments or bring more cash. There's no automatic exit clause for low appraisals, though. You have to negotiate. You're required to. And then if you can't negotiate something that works for all parties, pull the ripcord and get out of the deal. FHA loans have a mandatory clause, which lets the buyer walk away if the home doesn't appraise. The FHA appraisal sticks with the property for 120 days. So that affects future buyers. So FHA is something that you'll see with first-time buyers or people that really only want to put down 3 to 5%. And that's to be your lower price brackets, your 500 or less in most cases, which means you have a larger buyer pool to pick from, but at the same time, they're tight. So if somebody's using an FHA loan, they have a clause in that package that lets them walk away if the house doesn't appraise. VA loans have something called a Tidewater process, and that gives advance notice if the appraisal might be low. Buyers can request a reconsideration of value, ROV, for a second review. So that Tidewater process is actually super helpful if you have a buyer getting a VA loan. And VA loans we see in all kinds of price points, even the $1 million+ stuff. It's called a jumbo VA loan. So if that appraisal comes in low, you can actually ask them for a reconsideration of value as long as you have supporting comps that can take that value up. So it has to be something of like style. It's got to be something within the same realm of location, and it has to have taken place prior to when the appraisal has taken place. If you have a comp that settled a week ago, but your appraisal was 8 days ago, they can't really consider that comp. So you got to be strategic about how you do that, and a good agent will be able to walk you through how to navigate that process. If you're using FHA or VA financing, your lender's policies will affect how you handle a low appraisal. So make sure that you discuss it with them up front if you think it could be an issue. Let's get into Maryland market trends and if appraisal gaps are still common. So a couple years ago, gaps were everywhere, and that was due to the rising prices. Today, it's happening a lot less often as the market kind of balances out, but that means that that's a very general look at things. What we're also seeing right now, especially in hot properties, hot neighborhoods, properties that are turnkey in these highly sought after areas, bidding wars. And whenever you get bidding wars, you're getting removal of contingencies, you're getting above the asking price, and you'll see it again on those. Fewer bidding wars usually means fewer inflated prices. Appraisal gaps dropped from 19% of deals in 2021 to about 8 to 10% today. So most deals still close. Buyers and sellers are finding ways to negotiate gaps, but keep in mind, a low appraisal doesn't have to ruin your deal. You just have to have the right strategy and some expert guidance so you can navigate appraisal gaps and close with confidence. So if you're buying and selling in Maryland and you want expert advice on appraisals, connect with an agent that really knows their stuff.